Hey, thanks for checking out this video. I'm Mike Castronovo, your Music City mortgage coach. And as we head into mid-year of 2023, I thought this was a great time to give sort of an economic update in where things are heading, what housing prices are going to do, what interest rates are going to do. There's a lot of mixed news out there. Everyone is kind of scratching their heads. You turn one way, they say everything's going up. You turn the other way, they say everything's going down. I wanted to help you make heads and tails of that. Now, personally, when I tune into a video like this, I hate to have to wait till the end to find out the answers. So I'm going to tell you the answers up front, and then I'm going to give you the explanations of why. So housing prices are going to continue to go up. They're not going to pull back. There's not going to be a drop. There's not a housing bubble going on. And in terms of interest rates, everyone in my industry is expecting rates to trail down as we go into the end of 2023 here. They're not going to go down in 2023. They'll probably start coming down in the spring of 2024, meaning March, April, going into May. That's when you're going to see interest rates and mortgage rates start to come down. So stick around. I'll tell you why. For those of you that don't know me, welcome. But you're probably wondering, why should I listen to this guy? I spent the first 14 years of my career down on the trading floor at the Chicago Mercantile Exchange. I'm still the youngest member in their 125-year history. And for 7 years in a row, I ran the largest institutional trading desk for short-term interest rates, futures, and options. I was known for talking to bankers and hedge funds around the world every day, asking my opinion what interest rates were going to do. I had a great reputation for long-term calls on the market. And when I transitioned into private mortgage banking and wealth management, I was known for calling the markets there as well. In 2007, going into 2008, I was one of the few voices out there that told people that housing prices were going to drop 40%. I told them that short-term interest rates, which were currently at 5.88%, were going to drop to zero, and we were going to stay there for a decade. Well, housing prices dropped to 40%. Interest rates went to zero. They stayed there for 8.5 years. So I'm still going to take that one as a win. I say all that to let you know that I don't just always sort of talk my book or talk my position. In other words, I'm not going to say stuff to make you buy a home just because I think it's a good thing for you to buy a home because I get a mortgage out of the deal. That's not me. That's never been my style. I'm going to tell you the reasonings why. I'm going to be the first to tell you if I think housing prices are going to drop. So why is there so much disagreement out there? Well, let's look at some of the key factors. Leading economic indicators, U.S. leading economic indicators are actually pointing down and heading negative. And usually when that happens, as the National Bureau for Economic Research says in these charts, they're signaling recession within the next 12 months. So if that's the case, why is the U.S. Fed and other central banks around the globe all talking about continuing to tightening as we go into the end of 2023? The answer is really pretty simple. It's inflation. Prices are still going up on goods and services and commodities across the board. The bigger factor causing inflation here is government spending. It's always been out of control. It continues to get worse and worse, and there is literally no checks and balances. I love this chart from wolfstreet.com. Incredibly spiking U.S. national debt hits 30 trillion, debt out the wazoo. Now you look at all those debt ceiling increases, we've had them our entire lifetimes, right? There's dire warnings that the government's going to shut down, that no one's going to get paid. Is Congress going to pass a new debt ceiling limit? And everybody wrings their hands. And at the 11th hour, they always strike a deal and they always raise the debt ceiling. It's almost come to be expected that it's almost like the boy that cried wolf, right? But what was interesting about this last one is they didn't just raise the debt ceiling. They actually changed the wording of this a little bit. And they actually suspended the debt ceiling, at least through the election, meaning Congress can continue to spend like a bunch of drunken sailors between now and the elections to buy votes. And I'm not talking about paying cash to buy votes. I'm talking about paying for projects in different areas and things that their different constituents want in order to buy votes. Although, are they really buying votes? Seriously, though, the national debt is out of control. In March of 2020, it was at 23.5 trillion. And by the end of 2020 with COVID, it was at 27.5 trillion, a $4 trillion increase. Essentially, you had a 20% increase in our already bloated national debt in 1 year. But it didn't stop there. In the next 2.5 years, it went up another $5 trillion and now stands at $32.2 trillion. That's almost $100,000 for every man, woman, and child in the United States. So what does that mean for housing prices? As the government continues to print more money, the definition for inflation has always been too many dollars chasing too few goods. And not only is there not enough housing available out there, but inflation just really means that your dollars buy less. And when that happens, people move into hard assets because hard assets retain their value. That's why you hear people talking about buying gold and silver and buying real estate. And even though we're seeing some signs of slowdown from consumer spending, consumers are still spending and need to spend more on their mortgages. The average size of a mortgage in the US back in 2008, before the market crashed, was $260,000. By 2012, that had dropped back down to $210,000 for the average mortgage size. 10 years later, that amount's more than doubled. And as of March last year, it was up to $460,000 for the average size US mortgage. Now, keep in mind that mortgage rates hit their low on January 7th in 2021. They got down to 2.65%. You hear some people that talk about getting threes and a low threes. Not too many people got below 3%, but they did, in fact, get that low 2.65. So here's part of the problem that's causing a bottleneck in supply. Let's say you took out that average mortgage down at 3%. Your monthly principal and interest payment would be $1,939 a month. That same size mortgage today at roughly 7% would be $3,060 a month. That's a 57.8% increase in housing payment on the same size mortgage. And that's why over 82% of Americans are in a position where they wouldn't want to sell their home unless they absolutely have to, because they need more bedrooms for more kids, or because they're being relocated for a job, or they want to move across the country to a better location. Numbers for home prices came out this past week, reporting for April from both Case-Shiller, which is the gold standard in home pricing, and FHFA, which is the Federal Housing and Finance Agency. And as you can see, they've been trending up so far all year. And because in most parts of the country, there's not enough homes available for sale, consumers are turning to new construction. The month-over-month numbers that economists were looking for in new home sales for the month of May was 675,000 annualized units. That number actually came in at 763,000. That was a 12.2% increase month over month. So what's driving this demand? Now, I've talked about this in the past, but basically it comes down to demographics. And this chart probably shows it most accurately. Each one of these bars is representative of the amount of people at each age bracket. Now, the thing that's important to note here is that the median age of first-time home buyers is 34 years old. So those first two red lines on the right, where the black line is drawn across the top, are those that are currently 35 and 34 years old. And you can see the ages of those behind them that are coming into their first-time home buying years. When you look at the existing home supply combined with the amount of new home starts and new home sales, new homes that are being built, there's still a major shortage of supply of housing. And because of that, demand is going to stay high. A lot of that is going to be pent up if interest rates stay high. And as interest rates come back down, and that average mortgage payment on an average size mortgage goes from $3,060 a month back down to just over $1,900 a month, far more people are going to be able to qualify, and you're going to get back to seeing multiple bids and multiple offers coming in on homes. And so it's for that reason alone that my advice to you today is buy now while there's less competition in the marketplace. If you're fortunate enough to be in a market where there's a lot of extra supply, use that as an opportunity to negotiate with sellers, see if you can get them to pay some closing costs or some points. A great strategy for a lot of people right now is to have the seller pay points to do a 2-1 buy down. That means you get a lower interest rate, 2% lower than the current rate, for your first year. You get a 1% rate lower in year 2. And by year 3, it goes back up to today's normal rate, but you're likely going to be able to refinance, and in most cases do a no-cost refinance well before those rates adjust up. So don't let the current rates scare you off. Don't let all the talk of housing prices are going to come down scare you off. And if you have any questions, I'd love to talk to you further. Feel free to give me a call or shoot me a text anytime. I appreciate you taking the time to watch this video. Please be sure to like and subscribe and share this with friends and others that you know that would benefit from the information in it. Thanks for watching.